If you're even considering buying a house in Florida right now, this is something you'll want to pay close attention to. What you're about to hear could honestly save you from making a financial decision you might regret for decades. Across Florida, there are 10 major cities flashing serious red flags, and most buyers are completely overlooking them. Here's the reality. Purchasing in the wrong market could cost you tens of thousands of dollars once the housing landscape shifts in 2026. This isn't hype or scare tactics. It's backed by real data. Insurance premiums are skyrocketing, property taxes are climbing fast, and the numbers clearly point to several Florida cities facing sharp price declines in the near future. So this is what we're doing today. We're taking a hard look at 10 specific cities in Florida where home values are projected to fall the most in 2026. No speculation, just real statistics, real trends, and clear explanations for why these markets are under serious pressure. For years, Florida was on fire. People flooded in for the sunshine, the lack of state income tax, and what used to be relatively affordable housing. And for a while, that formula worked. Home prices climbed, listings were scarce, and sellers held all the leverage. But that momentum is fading. Fewer people are moving in. The insurance crisis is getting worse, and more families are realizing that Florida simply isn't the bargain it once was. In many areas, homeowners' insurance premiums have doubled or even tripled, and several insurers have pulled out of the state altogether. When buyers can't afford insurance, they stop buying homes, and that's when prices start to slide. Stack that on top of rising property taxes, increasing HOA fees, and growing flood risks, and you have a textbook setup for a market correction. So let's break it all down. These are 10 Florida cities where home prices are expected to take the biggest hit in 2026. Number 10. Cape Coral. Cape Coral used to be held up as the perfect example of Florida's housing boom done right. It checked every box buyers were looking for. Glittering waterfront homes, an endless network of picturesque canals, and price points that felt reasonable when compared to places like Miami or Naples. During the pandemic, retirees, families, and investors piled in, all chasing the idea of a laid-back coastal lifestyle without the eye-watering South Florida costs. But that picture-perfect vision is starting to crack. Ironically, the very feature that made Cape Coral so attractive is now working against it. With more than 400 miles of canals, the city ranks among the most flood-vulnerable areas in Florida. When severe storms roll through, those canals don't just look scenic. They overflow, sending water directly into surrounding neighborhoods. After repeated hurricanes and steadily rising sea levels, the insurance situation has reached a tipping point. Many homeowners are now facing an uncomfortable reality: insurance bills that rival, or even exceed, their mortgage payments. Annual premiums of $10,000 or more are becoming common, and in some cases, residents can't find coverage at all. Several major insurance companies have completely exited Southwest Florida, leaving buyers and owners scrambling. At the same time, home values are sliding. Median prices that once climbed above $400,000 are now moving in the opposite direction. Inventory has more than doubled compared to last year, and listings are lingering on the market for months. Even buyers with cash are backing off, wary of the long-term financial and environmental risks. And it doesn't stop there. Ongoing red tide outbreaks have damaged water quality and pushed tourists away, hitting the local economy. Meanwhile, the city's infrastructure, everything from drainage to utilities, is struggling to keep pace with the population boom of recent years. Cape Coral is now confronting a hard truth. Its growth happened faster than its ability to sustain it. Much of the city's rapid rise was driven by speculation, low interest rates, and a surge of outside investors. But as borrowing costs rise and insurance becomes increasingly unaffordable, that speculative momentum is fading quickly. There's no denying that Cape Coral still offers sunshine, natural beauty, and long-term potential. However, the housing market is undergoing one of the sharpest corrections in the state. For now, the city is discovering that even paradise has consequences, and those costs are finally coming due. Number 9. Naples. For a long time, Naples represented the pinnacle of luxury living in Florida. It was the place where manicured palm-lined streets met flawless beaches, and home values felt almost immune to market forces. Wealth, prestige, and exclusivity defined the city's image, making it the ultimate destination for high-end coastal real estate. Fast forward to 2025, and even Naples is beginning to feel the strain of Florida's broader housing reset. During the pandemic surge, the city's median home price pushed past $1 million, fueled largely by cash-heavy buyers and retirees searching for upscale waterfront living. That momentum has started to fade. Prices are now slipping, down roughly 12% year over year, as the number of buyers who can comfortably afford these homes continues to shrink. Luxury condominiums that once sold out before construction was even complete are now lingering on the market for months. High-end waterfront estates are facing the same issue, with sellers quietly cutting prices, sometimes by hundreds of thousands of dollars, just to spark interest. The biggest surprise, though, is the true cost of owning property here. In coastal Collier County, insurance premiums have more than doubled since 2022, and some homeowners are staring down annual policies that exceed $25,000. Even affluent buyers are starting to question whether the numbers still make sense. Add rising property taxes, escalating maintenance expenses, and climbing HOA fees, and both investors and retirees are seeing their margins disappear. On top of that, the once relentless stream of newcomers has slowed. Higher mortgage rates and tighter household budgets mean fewer out-of-state buyers are making the leap. Many who purchased at the height of the market are now realizing they overpaid for homes that are losing value. At the same time, the rental market, previously a reliable safety net for second homeowners, has cooled, forcing landlords to cut rents or absorb financial losses. None of this takes away from Naples' undeniable appeal. Its beaches, championship golf courses, and world-class amenities still support long-term desirability. But in 2025, the city is confronting something it hasn't experienced in decades: real vulnerability. A mix of inflated prices, rising ownership costs, and climate-related risks has pushed Naples to a critical turning point. The market isn't crashing, but the correction is sharp and impossible to ignore. The luxury bubble that once powered its growth is slowly deflating, and now the question isn't if prices will drop, but how much. Even in a place like Naples, pressure eventually shows through. Number 8. Jacksonville. Jacksonville was one of the biggest winners during the remote work explosion. As people fled crowded, high-cost cities in search of space, flexibility, and sunshine, this northeastern Florida port city quickly rose to the top of the list. Its reputation for relative affordability, expanding job opportunities, and access to the coast made it feel like the perfect balance of value and lifestyle. But as 2025 moves forward, that surge is clearly losing steam. Active home listings in Jacksonville have jumped by more than 80% compared to this time last year. After years of rapid appreciation, prices are now moving in the opposite direction, down roughly 12%. That shift has rattled confidence in neighborhoods that were previously red-hot, from Riverside and San Marco to fast-growing suburban areas like Nocatee and St. John's. Homeowners who once expected multiple offers and bidding wars are now dealing with price reductions, longer days on market, and buyers who are far more cautious. The underlying issue is affordability, and it's becoming harder to ignore. Property taxes in Jacksonville have risen significantly, while homeowners' insurance costs have nearly doubled in certain zip codes. Meanwhile, wages haven't increased fast enough to keep pace. Even with a solid employment base anchored by logistics, healthcare, and finance, housing costs are simply rising faster than household incomes. As a result, many families who once viewed Jacksonville as a safe and accessible entry point into the Florida housing market are starting to think twice. Builders are feeling the pressure as well. After aggressively expanding to meet pandemic-era demand, developers are now sitting on excess inventory. To move homes, incentives have become standard practice. Everything from discounted prices and mortgage rate buydowns to free upgrades and closing cost assistance. This flood of supply has taken the wind out of the market across the entire metro area. Jacksonville still benefits from a strong economy and one of the most strategically important locations in the state. However, its housing market has clearly shifted into correction mode. The city's rapid rise created expectations that couldn't realistically last, and with higher ownership costs and softer demand, Jacksonville is now facing a sobering adjustment that could shape its real estate market well into 2026. Number 7. Lakeland. For a long time, Lakeland occupied a comfortable middle spot in Central Florida. Sitting neatly between Tampa's beaches and Orlando's theme park sprawl, it was widely promoted as the affordable option, a place where homeownership still felt within reach. By 2025, however, that affordability edge has largely vanished. Since 2020, home prices in Lakeland have surged by more than 50%, pushing the median home value well beyond what most residents can realistically afford. Local incomes tell the story clearly. The median household income sits around $65,000, while the typical home now carries a price tag north of $350,000. That widening gap has forced many would-be buyers to pause and has kept renters locked in place. At the same time, the city's infrastructure is feeling the strain of rapid growth. Traffic congestion is worsening, public transportation options remain limited, and schools are increasingly overcrowded. A city once valued for its ease and convenience is becoming noticeably more difficult to navigate on a daily basis. Despite being inland, Lakeland is also dealing with an unexpected challenge: flooding. Heavy rainfall combined with runoff from nearby lakes has caused repeated property damage in certain areas. In response, insurance providers have raised premiums across the board. Some companies have even scaled back coverage in higher-risk zones, which only pushes costs higher for remaining policyholders. Investors who rushed into Lakeland during the boom years are now heading for the exits as profit margins disappear. Homes that were once snapped up as rentals or quick flips are being relisted, adding even more inventory to a market that's already crowded. With listings climbing, buyer demand easing, and affordability continuing to erode, home prices are slowly but consistently moving downward. Lakeland's growth was built on accessibility and optimism, but both are fading fast. While the city still offers charm and a central location, the financial math no longer works the way it once did. What was once a success story is now a cautionary tale. Proof that even promising markets can overheat when home prices rise faster than incomes and infrastructure can support. Number 6. Port St. Lucie. Port St. Lucie was long considered one of the quiet success stories along Florida's Treasure Coast. It built a reputation as a family-oriented community with well-kept neighborhoods, wide roads, and plenty of room to expand. For years, it attracted buyers leaving Miami and Palm Beach County who wanted more space, less congestion, and better value. By 2025, though, that value proposition is starting to fall apart. The local housing market is now showing clear signs of oversupply. New construction has ramped up far faster than buyer demand, leaving entire stretches of unfinished or unsold homes throughout St. Lucie County. Builders who once struggled to keep homes on the market are now resorting to aggressive tactics, offering steep price cuts, free upgrades, and mortgage incentives just to bring buyers in the door. Home prices are already down close to 10% compared to last year, and inventory has climbed to its highest level in more than a decade. At the same time, homeowners are feeling pressure from multiple directions. HOA fees are rising, insurance costs continue to climb, and job growth in the area has slowed, putting added strain on household budgets. Even basic homeowners insurance for a modest single-family home can now run $5,000 to $6,000 per year, and properties located in flood-prone areas often face much higher premiums. As a result, Port St. Lucie's affordability advantage is disappearing quickly. During the pandemic, the city attracted remote workers, retirees, and families searching for space and lower prices. Now, with mortgage rates still elevated and insurance expenses surging, many of those same buyers are being priced out. Some residents who purchased at the height of the market are already underwater on their mortgages. While the local economy remains stable, it simply isn't strong enough to justify the rapid price growth seen in 2021 and 2022. New employers are moving in at a slower pace, and many residents still rely on long commutes to reach higher-paying jobs. Meanwhile, the rental market has cooled, making it harder for investors to offset their carrying costs. For now, Port St. Lucie's housing correction has been relatively mild. However, the trends point toward deeper declines by 2026. If inventory continues to rise and affordability keeps slipping, this once thriving city could experience some of the sharpest price adjustments along Florida's East Coast. Number 5. Fort Myers. Fort Myers has long been one of the most visually stunning cities in Southwest Florida. Palm-lined streets, waterfront neighborhoods, and postcard-worthy sunsets made it easy to fall in love. On the surface, it still looks like a coastal dream, but underneath, the local housing market is continuing to grapple with the lasting fallout from Hurricane Ian. The storm left a deep mark. Thousands of homes were destroyed or badly damaged, and rebuilding has turned out to be far more complicated and far more expensive than anyone anticipated. Even 3 years later, the impact is impossible to ignore. Construction materials remain costly, skilled labor is still in short supply, and insurance premiums have surged dramatically. In flood-prone areas, many homeowners are now facing annual insurance bills ranging from $10,000 to $20,000, assuming they can secure coverage at all. Several major insurers have stopped writing new policies in the Fort Myers region entirely, forcing residents to rely on limited and expensive alternatives. Home values have already dropped about 15% from their peak, and sellers who bought near the top of the market are finding it difficult to unload their properties without accepting significant losses. Buyers are hesitant, lenders are more cautious, and the once fast-moving sales environment has slowed to a near standstill. Signs of recovery are visible: new roofs, repaired marinas, rebuilt condominium buildings. But progress has been uneven. Some neighborhoods are bouncing back quickly, while others remain stalled, waiting on insurance settlements or delayed permitting approvals. This uneven rebuild has created uncertainty, which continues to keep many potential buyers on the sidelines. At the same time, population growth has cooled. Retirees who once viewed Fort Myers as an affordable coastal retreat are increasingly reconsidering, put off by rising ownership costs and heightened climate risks. With fewer buyers entering the market, higher expenses weighing on homeowners, and tighter lending standards, Fort Myers is facing one of the toughest housing periods it has seen in decades. The long-term appeal is still there. The beaches, the sense of community, and the overall lifestyle haven't disappeared. But in the short term, the financial equation is working against many homeowners. Recovery will take time, and the housing correction that began in 2024 is far from finished. By 2026, Fort Myers may still be rebuilding, not just its homes, but confidence in its real estate market as well. Number 4. Ocala. Ocala was once considered one of Central Florida's best-kept secrets. With its rolling hills, horse farms, and quiet retirement neighborhoods, it offered a rare mix of small-town charm and attainable home prices. For years, buyers flocked here to escape the rising costs of coastal Florida, while still enjoying space, privacy, and a slower pace of life. By 2025, though, that balance is starting to tilt. Home prices across Marion County have fallen by nearly 8% compared to last year, and the slowdown is visible throughout the area. New housing developments that once sold out before construction wrapped up are now only partially filled. Builders are responding by cutting prices, waiving fees, and throwing in upgrades in an effort to clear excess inventory. What was firmly a seller's market has quickly shifted toward buyers. Even so, many buyers are still holding back. The issue goes beyond housing supply. It's the rising cost of living. Homeowners in Ocala are dealing with higher insurance premiums, increasing property taxes, and climbing energy bills. For retirees living on fixed incomes, these added expenses are becoming impossible to overlook. As a result, many long-term residents are rethinking their plans. Some are selling earlier than expected, while others are choosing to relocate to more affordable states like Tennessee or North Carolina. Meanwhile, job growth in the area has slowed. Although healthcare and logistics remain key industries, wages have not kept up with inflation. Younger families who were drawn in by the promise of affordability are discovering that the financial math no longer works. The wave of out-of-state buyers that powered Ocala's pandemic-era boom has tapered off, leaving behind a surplus of homes and weaker demand. Ocala isn't in free fall, but it is cooling quickly. The affordability edge that once defined the region has faded, and with construction still outpacing population growth, the market will need time to rebalance. The city's lifestyle and charm are still intact, but the housing market needs a pause before it can regain its footing. Number 3. Punta Gorda. Punta Gorda is often described as one of the most beautiful coastal towns in southwest Florida. Nestled along Charlotte Harbor, it's known for sailboats drifting past pastel-colored homes and sunsets that bathe the sky in gold. For years, it attracted retirees and seasonal residents looking for refined, low-key coastal living without the congestion of larger metro areas. That vision, however, is now under serious pressure. Sitting squarely in one of Florida's most hurricane-exposed regions, Punta Gorda's greatest draw, its waterfront lifestyle, has turned into a major financial liability. Insurance costs have surged to staggering levels. Many homeowners are now paying $15,000 a year or more for coverage, and a growing number of insurers have stopped writing new policies altogether. When insurance becomes unaffordable or unavailable, homeownership starts to break down. Lenders become cautious, buyers step back, and transaction activity slows to a crawl. As a result, home prices have dropped sharply, with some neighborhoods experiencing double-digit declines since 2023. Retirees on fixed incomes, once the foundation of Punta Gorda's housing market, are increasingly leaving for inland areas that offer lower costs and reduced risk. At the same time, younger buyers are largely locked out, unable to manage the combination of steep insurance premiums and high purchase prices. The market is now caught in a fragile loop. Declining demand paired with rising uncertainty. Developers who invested heavily during the post-pandemic surge are pulling back. New construction has slowed, and vacant lots are becoming a more common sight along the waterfront. Even the city's marinas and resort-style developments are feeling the impact, reporting slower activity as tourism softens and insurance costs ripple through the local economy. Punta Gorda remains undeniably scenic, but the financial outlook is increasingly harsh. When the cost of protecting a home begins to rival the cost of owning it, buyer confidence erodes quickly. Looking ahead to 2026, unless meaningful changes occur in insurance availability and climate resilience planning, Punta Gorda's housing market could face one of the steepest declines in Florida, a place defined by beauty, yet weighed down by risk. Number 2. Tampa. Tampa's ascent was one of the most dramatic housing booms Florida has seen in recent decades. From a revitalized downtown skyline to rapidly expanding suburbs across Hillsborough and Pasco counties, the city became a clear symbol of post-pandemic growth and optimism. In just 5 years, home prices more than doubled, pushing Tampa into the spotlight as one of the fastest-growing real estate markets in the country. That rapid climb, however, has set the stage for a serious pullback. Today, the median home price in Tampa sits above $450,000, while the typical household earns around $70,000 a year. That widening gap simply doesn't work long-term. Families who once could afford an entry-level home are now completely priced out. And even solid middle-income earners are feeling the squeeze as overall living expenses continue to rise. Insurance costs are a major driver of that pressure. In some coastal areas, annual premiums now exceed $20,000, with many homeowners seeing their rates double or even triple since 2020. Property taxes have also climbed, reflecting the inflated values reached during the peak of the boom. Together, these expenses have pushed monthly housing costs beyond what many households can realistically handle. At the same time, investor activity, once the engine behind Tampa's explosive growth, is reversing. During the pandemic, out-of-state buyers and large investment firms poured into the market, purchasing homes as rentals or speculative assets. Now, with interest rates still elevated and rental demand softening, many of those investors are unloading properties. That wave of selling is adding significant inventory to the market and putting downward pressure on prices across the metro area. Meanwhile, longtime residents are leaving. Neighborhoods that were once filled with owner-occupied homes are increasingly dominated by vacant properties or rentals priced far above what local families can afford. Daily life has also become more challenging. Traffic congestion has worsened, commute times are longer, and basic living costs continue to climb. Even Tampa's biggest draws, sunshine, waterfront access, and economic opportunity, are no longer enough to offset the financial stress facing many homeowners. Tampa isn't collapsing overnight, but the correction is happening in real time. The surge that propelled the city to national prominence has reached its ceiling. By 2026, the housing market is likely to settle into a very different phase, one shaped less by bidding wars and more by cautious buyers and sellers grappling with the realities of affordability. Tampa's story is shifting from rapid expansion to uneasy balance, and that transition may prove to be its most difficult chapter yet. Number 1. Miami. At the very top of the list is Miami, Florida's dazzling emblem of luxury, ambition, and international wealth. For decades, this city seemed to operate by its own rules. Foreign investors, celebrity buyers, and cash-rich developers turned Miami's skyline into a symbol of nonstop growth. Condos sold before ground was even broken. Waterfront homes tripled in value in under 10 years. Even when the rest of the country slowed down, Miami just kept pushing higher. But in 2025, that long-standing narrative is starting to crack. Over the past year alone, Miami's median home price has dropped by nearly 15%. Condos that once disappeared from the market in a matter of days are now sitting for months. International demand, long the backbone of Miami real estate, has cooled noticeably as global economies tighten. Buyers from Latin America and Europe, who once viewed Miami as a rock-solid safe haven, are hesitating amid rising costs, tougher lending conditions, and growing climate concerns. And climate risk is no longer some distant future issue. It's actively reshaping Miami's housing market right now. Rising sea levels, stronger hurricanes, and newly revised flood maps are changing how properties are priced and insured. Entire neighborhoods once prized for ocean views are now facing staggering insurance premiums. Some homeowners are paying more each year for insurance than they do for their mortgage, while others have lost coverage entirely and been pushed into expensive, state-backed insurance programs. Developers are still building, glass towers continue to rise, and luxury condos are still coming online. The difference now is demand. Many of these projects are finding fewer buyers than expected. Wealthy investors are increasingly shifting their focus to other markets, places like Austin, Nashville, or even overseas destinations, such as Lisbon and Dubai. Meanwhile, local residents are being squeezed from both sides, caught between soaring rents and home prices that remain far out of reach. Miami's economy itself is still strong, supported by tourism, finance, and tech. But its real estate engine is losing momentum. Years of reliance on speculative buying have left the market exposed to global shifts in capital and confidence. And when confidence fades in Miami, the ripple effects are felt across the skyline. The city still sparkles at night, the beaches are still world-class. But beneath the shine, the housing market is clearly descending. What began quietly in 2024 is accelerating as we move toward 2026. For the first time in a generation, Miami is facing a question it hasn't had to confront in decades. How long can a city built on perpetual growth keep going once the tide starts to turn? So there you have it. 10 Florida cities where home prices are expected to take major hits in 2026: Cape Coral, Pensacola, Jacksonville, Lakeland, Port St. Lucie, Fort Myers, Ocala, Punta Gorda, Tampa, and Miami. Each tells the same cautionary story. Rapid expansion followed by a hard return to reality. Rising insurance costs, higher property taxes, and slowing migration are reshaping the Sunshine State. Before you buy, do your homework. Run the numbers. Get real insurance quotes. Understand the risks. Because in this phase of the housing cycle, timing matters more than ever. Subscribe to Discover the Cities for more cinematic, data-driven deep dives into America's housing markets. Because what's unfolding in Florida today may be a preview of what's coming next across the United States.